stoke the fire.
Yeah.
Buy into it. There's a trader on Market Wizards who used to talk about that. So whenever he sees a bubble, buys into it. The only problem with that is because the volatility increases, you do need to be ready to be out quickly as well. Hi everyone, welcome to another episode of World of Oil Derivatives. I'm Greg Newman, the Chief Executive of Onyx Capital Group. I'm here with Vincent and Martha on the research team and another podcast on the latest that's going on in oil and wider commodities, but specifically derivatives. Guys, just a reminder that we do film this in person. I know I say this every time, but we are trying to gear people to YouTube because there's graphics we use and put the effort to be there in person. So please look at it there if you can. And obviously, please like and subscribe. It does make a difference, as always, as well. Okay, so let's go with you, Martha, this time. What's the kind of summary of what's going on in outright prices since we last spoke?
Yeah, so in Brent flat price right now, we're below 84 handles. I think we're 83.60 right now. So prices are about 1% down into today. And it seems like the big story right now is China is the main focus again. Now we had the poor news last week. We had the PMI for manufacturing and contraction. And it seems like the demand narrative is kind of back into focus now. We've been waiting for this thing all year and now it's not coming and people just don't know really what to do about that. On the other side, in terms of products and refinery margins, we're seeing that the refiners are not going to cut runs, even though the margins are really weak, which we'll get to later. And this is exacerbating the move lower as well. This is kind of undermining any kind of confidence that people can have. Everyone, you're always pointing to other things and saying, oh, but what about the products? What about the margins? And this takes another one of those off the table. Also, in terms of product, getting a rally from products, there's the warmer than expected winter, the El Nino, which has been happening all year, well, most of the year. This is going to cause a warmer than expected winter in most of Europe, also Japan, which is really important for distillates. And that's going to be a really important factor. Not that looking at gas oil this week, but we'll come to that. And looking at the CFTC, you can see that managed by money positions have been on the decrease 5 out of the last 6 weeks, and they've sold a total of, they've been reduced their position by almost 250 million barrels. So that's really significant since mid-September, I think September the 19th. So yeah, it's not a very bullish picture right now. Of course, looking at the physical premiums, we're not terribly, we're still in a backwardated market. So we're just a kind of caught between a rock and a hard place right now.
Yeah, no, it's a good summary. I think I was putting in a report as well yesterday, I think it's something Vincent said a while ago, just less bullish of an environment. It's certainly what the numbers are reflecting, but doing a bit of digging around with traders yesterday, actually, not just Onyx, the physical is, at least in the crude side of things in Europe, is looking pretty bad, according to some of the physical guys. Everything you're saying, Martha, I think it's more of the macro themes you're talking about, but I think the underlying is starting to look like that now. At least the picture is, whereas the numbers on the forward curve aren't necessarily reflecting that.
Yeah. There's
really not a lot of good to be said, but I think, as you said, that rock and the hard place is that we're just not really in a free market, and that's the problem, right? At the end of the day, is it a third time this year, or probably fourth time, and if you go back a bit further, that it's about to fall off a cliff, and then kind of Saudis, OPEC save the day. And this time round, it's exactly the same. They go deeper into pockets, down to 9 million barrels per day on the crude side. They're going to need to intervene again because if they don't, everything is looking like it's about to spill over. And the only thing really left to go on the forward curve is the last thing you said, which is the backwardated time spreads and the physical diffs. So is it more likely that there's a rebound and everything catches up on the bullish side, or are time spreads the last thing to go? And everything really is pointing towards south. But I've literally said this 3 times this year, and then Saudi's come in and cut. So I guess it is possible again, and the meetings are coming up. So yeah, Vincent, not putting you on the spot, but what are the bullish things that are in the market the rest of Q4?
Apart from potential supply disruptions, we got gasoline, which has seen quite a substantial rally/rebound in the past few weeks. Cracks going from $4 to $5 to up to around $7 to $8 handles. Seems like the physical strength is very much returning, not only in Europe but also more specifically in Asia as well, especially looking into the
Can we put it up on structure.
Yes, for sure. So looking onto Flux, we can see this is the EBOB crack.
Yeah, it's had a really sharp rally.
A very sharp rally since the end of October. Looking at the wider picture though, it has fallen a lot since end of September recently. There's a meaningful bullish momentum we're seeing here, and also onto 92 specifically. So the East-West has seen strong performances, but also in the front 92 spread as well. So especially Asia tightness, potentially China reducing its exports, as well as some refinery outages, has really supported bullish sentiment, and that's helping the refinery margins claw back up again as well.
Yeah, there's also the Australian driving season, which is quite Asia focused in terms of gasoline. It usually supports them a little.
Okay, yeah, I've not heard that before actually. Yeah, but that makes sense. The thing I think the market naturally finds confusing, and understandably, and we do too, it's what narrative do you pick? You know, there's what it's looking like right now, and then you marry that with macroeconomics. But macroeconomics is very macro at the end of the day. Like, these big things happening, and they take a while and it's an overall trend which the investing community seems to be believing is heading south, right? That's the general consensus, I think, from the way the investors have been traded 5 out of the last 6 weeks, like you say, Martha. But in general, you know, the argument is a lot stronger to the downside from the macro side. But when you're looking at refinery margins and looking at how refiners and the oil market is going to start pricing, if you go back to the, 3-4 weeks ago, when we had this initial big sell-off, this was the time when we were starting to say it was the first big indication. It was when we were, I think, still above 90. And the gasoline and naphtha market was the cracks were just giving way again. And the whole margin was starting to collapse. And it was the first big bearish thing. And then it started to filter from there. But then nothing really changed on the gasoline fundamentals, at least from what people were talking about, and at least how we were discussing things. There was a very bearish picture from a macro sentiment point of view from the way physical traders were talking about. But this is the thing about the forward curve. And this is what is difficult, because you are trading months out, and at the end of the day, cracks are, EBOB cracks are gasoline levels relative to crude, and they were ultimately good levels to buy. And we were saying to buy, I mean, we're going to brag about this, we don't get everything right, but obviously, like last few weeks, we've been very concentrated on gasoline, because this is where the technical financial flows really do evidently have an impact, because there was a technical level there, but everything still looked bearish. But, we could start to see the buying. We started to see the forward speculative interest. And traders who have to make their money year in, year out, and they know the gasoline market very well, they didn't really care what the fundamentals were saying or what the macro picture was. So ultimately, the buying materialized, and there was enough open interest capacity for this buying to continue, and it's just not stopped since, and we don't think it's going to stop. But then the point I'm trying to make is that's now changed the whole economic landscape, because if gasoline cracks are very good, and naphtha cracks are also rallying, whereas gas oil is weakening. Like you say, Martha, there's not so much winter demand. There's just not a good picture, not a good outlook in general for the market. That's feeding into the fuel and gas oil market, whereas the light ends is doing quite well again, or at least better. So now that's that's completely changed everything, because this year was all about OPEC cuts, forcing heavy crudes to be very tight, light market being way oversupplied. WTI Midland way oversupplied, that's naphtha yielding, all the same story. And suddenly, the fact that we're still in the midst of like a really deep cut, the deepest cut, and yet now the light versus heavy is starting to flip. To me, that's quite a lot. That's a huge thing to happen. I mean, now the Brent Dubai at negative starts to look like a great buy, because it's a proxy for the light versus heavy. It starts to reshape how refiners are going to operate next year, early next year. And then finally, it's like, well, what do OPEC do? Because they've already cut. And yet it's not even their crude that's going to be the most sought after if we still have this light end resurgence. So for me, I guess what I'm getting at is what is the bullish argument, gasoline and say a bit of naphtha. It is pretty bullish in the sense that if you genuinely get a big refinery recovery on the light side, and that can clean up the WTI Midland and the light sweet barrels, that's pretty heavy in the prompt right now. It's pretty bullish for the Brent complex. Having said that, we're just at such high levels, and it's probably, I mean, you can argue this both ways, because the flip side of saying this is that the refinery margins are okay, but the overall market is oversupplied. So something else has got to give, like gas oil cracks have got to get nailed. But what in the puzzle, what in the picture has got to go if something has to fall south, if gasoline's going to keep rallying? I mean, what would your guess be, Martha? Again, not to put you on the spot, but do you follow the logic of what I'm saying?
No, yeah, completely. I see what you're saying about like throughout the whole year with OPEC cutting, but that not really being the issue with the oversupply. And I think something we said in one of our reports a few, like must have been months ago now, is that they're like trying to fit this round peg in a square hole, and like however hard you hit it, it's not really hitting the cause of the problem. But I think looking at the margins now, I mean, the margins are propped up by EBOB and gas oil, and gas oil coming into winter. I think fundamentally the market is really, really tight gas oil. So I think it's hard to see that having a massive sell-off.
The fundamental story is still, the physical picture story is still bullish gas oil.
It's a very tight inventory situation in both the US PAD 1 as well as Northwest Europe. But at the same time, you have bullish fundamentals, yet a lot of speculators are exiting gas oil contracts recently, according to CFTC data. So it's a confluence between seemingly bullish fundamentals with inventories versus bearish economic and macroeconomic outlook. So there's a lot of conflicting factors. I think the market's very uncertain about where to go.
Yeah, I think gas oil is like a really tricky one. You have that mild situation with the weather, and you have macroeconomic sentiment being weak. So again, it's looking at the forward curve. How are things going to play out? If we isolate gas oil and say it's really bullish, that's fine. But I guess, Martha, what you were saying before, it's an inventory bullish market. It's not necessarily the demand's there. Are you seeing the premiums, or is it just a stock story?
Seems like with the there's in the physical windows, there's previously wholesalers have been on the sell side. They've been found on the buy side again, but on the sell side, there had been some trade houses and majors. But it seems like with November expiring this week, that sell side flow could dissipate following expire, which could lead to more bullish sentiment for gas oil.
That would be a good one to watch then, the November expiry for gas oil, because it's all well and good having low inventory. I know people worry about it, and it's very much an indicator for like systematic strategies. Inventory is low around the world tends to filter into higher prices in general and time spreads and the rest of it. But one of the major things this year for being a bullish argument was the US SPR, and people were, it's drawn to the lowest level since 1983. But since then, the US now produces an incredible amount of oil. And how worried would you be as a government? I wouldn't be worried at all personally. I don't think we're going to run out of oil in the US. They set that thing up because of the shock waves that were caused in the 1970s. They didn't have nearly as much oil at the time. So it's just a different scenario. So I wouldn't lean on inventories in the same way, at least from the SPR. And I wonder if you could say the same thing about gas oil. The problem is if the weather does suddenly turn, you do get, say, like an economic recovery, these things can happen quite aggressively. Then suddenly you are under strain because of the stocks. But do you see my point? It's like stocks can be a lead lag thing.
Yeah, definitely. And I think with gas oil, was it this time last month, we were saying, we've had this really bearish expiry play in the gas oil, and then it flips because those, I think it was majors last time, had been played out. And I mean, it just seems like this could be another expiry play we are getting to the end of the month. It'd be really interesting to see that whether it is actually being fundamentally driven by these inventory levels or there's something wider afoot.
And this is another thing that we are still to properly figure out and relay to our clients with our data and all that kind of thing. But the thing I'm really excited about is on this exact point, inventories being low or inventories being high or building. It's the same thing about shipping. You should know you can know ahead of time, or you can have better information if you see the hedging flow, you see the derivative flow, or better yet, insight to what the physical is actually doing ahead of time. In other words, when you charter a ship, you see it, pop up on like your chartering app or like some shipping information, but it was booked like 3 weeks ago. And it might just be moving now. So everyone's looking at ship tracking software. It's like, but that was booked weeks ago. So in other words, if we're saying the inventories are low now, you should really pay attention to how the market is positioning in gas oil and around gas oil, because that's an indication of either what they're hedging or what they're taking a view on will happen going forward. So in other words, if inventories are low, that's a reason to get long right now. But if you also know that they're going to build in the next few weeks because you've either been filling storage yourself, or you've been seeing the storage hedging flow, or you've been communicating with refiners and they can't sell it, or refiners themselves are saying they can't sell it, then you know the inventories are going to build. Do you see about that league lag concept? This is why I think the hedging information is so like valuable, because it's ahead of time. So personally, I mean, this is very superficial analysis, but it's just the weight of the macroeconomic sentiment and the sentiment that seems to be there in the oil trading community doesn't speak to a prolonged tight gas oil market, and maybe the inventories will start to rebuild. But it could be very wrong. I guess this is the slight bit of contention right now. But what you have to say is, filtering it back to crude, the end of the OPEC cuts, or the recent OPEC cuts, is meant to be December, right? And we're trading December loading barrels. We traded them in the expiry on Brent recently, and now we're trading them more in the prompt. Looking okay, but looking a bit like weighing down on sentiment. And this is before we've come back with more Saudi crude. And I think as soon as you bring that oil back online, there's a discussion to be had about flat price. But I think for the guys wanting to look at the physical economics, something needs to give way. So this goes back to what I was saying earlier on. If we think gasoline is going to perform, it's still got legs to perform on a technical basis and whatever else, then something's going to have to give on a crack basis when more crude is put online. So that will be a great indication that either the market can't take it and a crack will like be destroyed, like fuel oil and gas oil, or if they maintain and there's more supply and the physical differentials on the crude side maintain, then we're in a healthy market. So I think for me, the one to watch, like towards the end of the year, and certainly after the OPEC meetings, I think back end of this month, and looking at the policies as we go into next year, you've got to look at how gas oil reacts in the next few weeks, and to any indication of more heavy supply.
I think it's worth remembering the notional value of gas oil remains pretty high recently. It's still in the upper 20s. It seems like $30 per barrel is the resistance level. So it's very
on the crack basis.
Yeah. The gas oil swaps, and that's still compared to previous years, excluding last year, is still very, very high and still very close to summer's levels, which are trading in the 30s range. So, and earlier this year, Q1, Q2, we were seeing gas oil coming off to in the mid-teens, high teens. So there's room to fall, but it seems that gas oil is, on an overall basis, still quite supported. So if something has to give, I would say a lot of length and a lot of long still in the money in gas oil, they could.
Honestly, really agree, and I think we shouldn't underestimate the power of like these psychological levels, because $30 per barrel. I mean, in my time trading, it's only 10 years or whatever, but gas oil was always in like probably around +8 to +20 range, and +20 was the really strong levels. Like when IMO 2020 was being announced, and people were starting to position on the cracks as a way to reflect, bullish diesel on the back of less residual fuel being used, all that. $24 on the crack. I thought, wow, this is a really strong level. And people were getting really hurt on these positions because they were fading on the highs of the ranges. And now 30 seems standard because we had 40 last year. So everyone's gotten used to 30. And I think at the beginning of the year, when we had a bit of a crash, it came back up. People are they're just getting used. It's a bit like if you rewind back almost 10 years ago now, when we had the original sell-off down to like $40 on Brent from $100 per barrel. Every time it went below 100, everyone's like, the Chinese are going to come back in and buy and fill their storage. OPEC won't let the oil market go below $100 per barrel. And people really genuinely put their money where their mouth is with these psychological levels. They come in and they buy it, just like we saw with gasoline. There was no reason to buy gasoline other than a technical level being supported and it being likely that when it comes to pricing, it will rebound. That's the only reason people bought. But then it had a material impact on the whole market from that buying, that whole financial markets wagging the dog type thing, being the tail that wags the dog. No, it's going to be like super interesting if, as you say, suddenly we kind of go, why are we buying $30 cracks? And could it not easily be 10 or 12? And that would just reset everything. Like that is a really big structural impact on the market. But we probably talked enough about that. Focusing back on the trading, I think we have to say we haven't loved the crude environment directionally, and we've haven't been that confident for the last few months. Think the market's weak and continues down to 80, maybe superficially on Brent, but you can never be that confident because of OPEC's moves that are likely and all this kind of stuff. So I think the only thing we've had conviction in materially, I think that sustainably for the last couple of months is gasoline, as we've been saying. So more on that theme, what is the latest? We have had the response from the crack market, from the spreads, but Martha, you had more to suggest going forward, right?
Yes, the trade of the week this week, we're looking at going long in the DEC Jan 92 spread. We believe this has pretty good risk reward right now. It's been trading fairly range bound, around $1 over the past like month or two. We'll start with like the fundamentals of the situation. So last month we had the really strong expiry that we've already mentioned in 92 and in Europe, and it seems like the strength in the East is kind of helping the European gasoline kind of break away from the RBOB structure, which we've seen like as EBOB has held strength even when rubber has been weakening. We've seen in the 92 since expiry, we've seen refinery buying, market makers lifting the curve, and continually well bid MOC in December and January for the past week, but well, mostly in December. And we've got the Australian driving season coming up, which usually focuses most of the strength in Asia. So the important thing that's happening right now, which is causing this kind of dry up of volatility in the market, is that the market is waiting for the Chinese export quotas. And we've heard these are coming like at the beginning of December, but we're not really sure here because, of course, they're keeping it secret. So we've seen OI decreasing in December over the past couple of days. We've seen volatility really, really low. It's had a really significant decrease over the past month or so. And liquidity is really good. So this is kind of indicating decent liquidity conditions, low volatility, and quite a sideways market.
On Dec Jan spreads still,
in the Dec Jan spreads. This usually predicates a significant breakout because the players are seeing it as a low risk environment and the volume is building up. And so we think that once the export quotas are released, this could be a really bullish thing, and the market is willing to go long in it because we have seen these like bullish players stop out, which is the OI decrease, so they'll be willing to put their bullish positions back on. So we think that that would be a good bullish position to take.
So expecting a blowout, basically, yeah. The only thing I would say is the absolute levels. Like this is dollars per barrel, and $1.20 per barrel is already like a pretty strong number on a time spread. So if expecting this to blow out, I guess it's a real blowout. You must be like the market will need to have, right? This is like expecting $2-3 backwardated premiums, which is rare. But it is not dissing the trade. It's just that will be like a pretty significant rally, and it could well happen based on what I'm saying. Because I'm like, well, that's a high number. Can it rally anymore? It's like, yeah, because there's like loads of buyers, loads more open interest, and numbers don't really mean anything at the end of the day. So that's an interesting one. And I've seen that so many times, by the way. Like I even remember like a long time ago, there was Drugba pipeline when that went down or got contaminated rather. The DFLs were like already like quite well backwardated. At the time, that was rare. And basically, I think it was 2019. And we we're kind of thinking, yeah, but if there's contaminated oil, like basically Urals has been taken offline, all the European refiners are going to have to switch to North Sea crude, or at least it's going to impact North Sea crude as a domino effect. And then the whole market is going to get tight and we're going to have a big rally in Brent spreads and DFLs. And I went around like kind of talking about this, and traders were like, yeah, but can dated rally any higher? It's already so high. It's like, but so what? Like it's about to absolutely blow out because of this scenario. So you could be long because people just didn't want to be long, and they weren't rushing into the trade because they just didn't believe in the level. So that was like the reverse of what we're talking with the EBOB crack, buying at a really low level, expecting speculative buying. This was like the opposite. So a lack of buying because people are like, yeah, but the level's too high. So if you extrapolate that to Dec Jan in the 92, if people are like, yeah, but it's already high, yet you've got all this like really bullish stuff coming, they'll catch them unawares, and you will get a volatility spike as everyone rushes in and didn't call it correctly because they were just too biased to a number. You see what I mean? So I love trades like that.
Yeah, and I think the other like thing to consider, I know we're talking about a few weeks ago on the podcast, is like whether to even just consider a volatility trade. Like as soon as the like export quotas are released, as soon as people are like buying the rumor, this volatility is going to really significantly increase. And I mean,
stoke the fire.
Yeah.
Buy into it. And I think there was a trader on Market Wizards who used to talk about that. So whenever he sees a bubble, buys into it. Because it's like, it's going to spend some time exacerbating. But then you have to, so you're basically talking about being early in it, seeing this rush, and then making sure. The only problem with that is because the volatility increases, you do need to be ready to be out quickly as well.
Yeah, definitely.
So it's a hard one to structure the trade craft around, because I know you're saying, okay, so there's a volatility spike expected, so you would want a wide stop.
Yeah.
But this is where it gets tricky. But if what you're telling me is just a volatility trade and it's short term, then actually you want quite a tight stop originally, because if it's not going to happen, then you just want to be out. And if it does happen, you pretty much expect it to be a one-way street, like a pure momentum trade. And I know this sounds contradictory, but you're not expecting a long-term trend necessarily.
No.
Yeah. So in that case, you probably just want to set yourself like profit targets, get ready to exit at those levels straight away.
Yeah.
And or once you get the volatility spike, you kind of have to be quite quick to get out of it, because volatility, as soon as things go up highly, they can also crash back down as well. So it makes for an awkward structuring of trade. And I know that's the beauty of this kind of stuff. So does that make sense? I would, you expect to blow out, and you could do it on a purely technical basis. So you buy into it, have your stop maybe around $1, looking at this graph, and then you expect it to blow out, and you probably put your target levels like 170, 180. If you expect that's enough room for the market to have priced in like a blowout, if that makes sense.
I feel like, Martha, if you an example might be also Greg. So I'm putting this on my screen here. The recent example of how the 7.5 crack blew out because of VLSFO tightness and market stop outs. So classic example, previously, range bound low volatility, and then all of a sudden over the past week things just blew up higher. So from low volatility into a high volatility. So I assume in the early part you might have a tight stop loss, and then as prices go up, then the stop loss is
12. Yeah, this is big moves.
Yeah, it was huge.
Well, there you go. So it's kind of what you're expecting on gas. Okay, well, there you go. So if you look at how it's broken out, you want a tight initial stop, I would say, because if it's not going to happen, it's not going to happen.
Yeah, definitely.
And then once you're in it, it's just awkward, but the taking profit's going to be the hard bit, because you don't want to be selling. If you go, once it starts to turn, I'll sell. But if it's in a high volatility environment and you've said it's high liquidity and liquidity suddenly is a drought, then you're not going to be able to get out of it. So you kind of need to me, you need to set your levels, I think, as a profit target, and then possibly a timing stop as well. If you get this explosion in volatility, you're willing to run it for a bit, but over a certain period of time, I think it's just to get out. So yeah, it's a tough one, but at the same time, you can give yourself quite a good option, because if you're willing to look, it's just not happening, there's no volatility, then if there's no volatility, then you just want to be out of it because it's not what you expected, and that's fine. So yeah, that's a really interesting one. Let's see how that plays out, and that's a good spot actually as well. Cool. Nice. All right, and to finish this off, I guess maybe we do need to be clear about what we're expecting next. So eyes on gas oil maybe for the next couple months. Definitely the expiry this week. Is it this week? Next week?
This week.
Yeah.
And we should probably be expecting OPEC headlines, as we get towards their policy for next year. And I bet analysts will start to come out as well as we head towards the end of the year as well, setting their kind of what's going to happen next year type thing. So the conclusion of that is probably a continuation of risk off in the flat price market. People just wanting to just wait and see because there's nothing concrete. So gasoline should be your focus really, because it's ours, is what we're saying.
For sure. It's all in the refined products.
Yeah. All right, cool. Well, cheers guys. And thanks for those of you reaching out. Really useful and interesting what you've got to say. And yeah, see you next week for more of the same. Thanks.
Thank you.
Thanks.